Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines. Normal monsoon predicted for this year could bring big relief from high prices, even as some economists believe that the Ukraine war will keep price pressures up. Big push towards privatization of railway stations and other assets this year. Niti Aayog CEO tells Business Today TV that the government's monetization target has been set at a whopping 1.6 lakh crore rupees. More on disinvestment. Sell-off season expected to start with Pawan Hans this fiscal. Crucial meet of secretaries next week to vet possible bidders for the helicopter services company. After TCS stellar numbers, Infosys disappoints with its Q4 results. Revenue and profit below street expectations. Company will give salary hikes from April and hire 50,000 freshers this year. Markets end a truncated week on a somber note, declining for the third straight day. Inflation woes weigh on markets, with Sensex tumbling 237 points and Nifty shutting shop below 17,500. Even as inflation hits a 17-month high thanks to a war in Ukraine and other factors, the question everyone is asking is, will a normal monsoon take the heat off the skyrocketing prices? SkyMet, a private weather forecaster, has predicted a normal monsoon, and economists are hoping for a big relief from the sudden price surge.
For want of peace in Central Asia, the world is losing the battle against prices. Crude oil is pricier. Global prices of cooking oil have shot up. Even wheat prices are higher, prompting this warning from Russian President Vladimir Putin.
I can assure you, when people face rising prices of petrol, food and unprecedented inflation rate, it will impact domestic political processes.
In India, inflation is at 17-month high in March, with no indication of a relief anytime soon. In the mandi, lemons are selling at 300 rupees a kilo, tomatoes at 50 rupees a kilo, while onions are at 40 rupees a kilo. Cooking oil prices are up nearly 19% in March. Vegetables are pricier by more than 11%. Meats and fish prices have risen by nearly 10%, while prices of spices are up 8.5%. The overall food inflation in March is 7.47% in comparison to 5.85% in February. All hopes for lower prices now hinge on a normal monsoon, helping India's agriculture economy mitigate the inflation shock.
There is a good monsoon, like normal monsoon, and rainfall is well distributed. And this will certainly help the agricultural community, like farmers and kharif crops, particularly the soybean, groundnut, pulses, and paddy crops. Will have bumper harvest, and the sowing will be on time, and which will certainly reduce the inflation.
Even the RBI has been forced to revise its inflation estimates upwards, exceeding the comfort band of 4 to 6%. However, even the central bank is hoping that a normal monsoon will assuage the pinch of higher prices. While the inflation estimate in the April to June quarter has been revised to 6.3%, it gradually tapers to 5.1% by the end of the present financial year. There are, however, skeptics who feel that monsoons won't do much good because much of it is imported.
Monsoon impact on the inflation will be will cool off if inflation is coming from the crop side or from the food side. This is coming from the commodities, which is where we have the import dependency, for example, the edible oils.
A consolation is healthy numbers which indicate a robust economic recovery from the pandemic period. This gives the government enough room to deal with the possible retardation an interest rate hike could bring to the economy. Bureau Report, Business Today Television.
As the new financial year begins, the government has stepped up its disinvestment efforts. Business Today TV has been informed that the core group of secretaries will meet next week on the divestment of Pawan Hans. The meeting will be to review the bids received so far for the helicopter services provider. As per sources, the government has received 3 financial bids for the stake sale. While ONGC owns 49% of the company, the government owns the balance 51%, which it intends to sell. Karishma Asutani joining us for more on this. Karishma, take us through the kind of program that the government has set for itself.
Well, Abha, the disinvestment drive, which is looking at about 65,000 crore, will now also cater to disinvestment of Pawan Hans this year. In fact, sources tell us that core group of secretaries will actually be meeting next week to finalize on the bidder's plan. And this will now be taken up further with the process along with the cabinet secretary on how this will go about. In fact, we are picking up that we're expecting to garner about 300 to 350 crore from sale of 51% in Pawan Hans. Well, that is going to be a big asset letting go of, and government has been quite in the process of selling it for the last few years, but because of COVID, the process was kind of hindered, but looks like now it's going to be a successful trip for the government to disinvest Pawan Hans, and this is one of the key aviation assets that the government is currently holding.
All right, Karishma, thanks for joining us with that story. Now, the ambitious National Asset Monetization Initiative has gotten off to a flying start, with the centre garnering over 96,000 crore rupees in just 7 months of fiscal 21-22, ending March 31st. This amount surpasses the target for the year by over 9% and sets the foundations for an even larger mop-up in the current fiscal. And that's not all. Speaking exclusively with Business Today TV's Managing Editor Siddharth Zarabi, Niti Aayog CEO Amitabh Kant also laid down the ambitious government plan of the privatization of several rail assets. Here's a slice of that exclusive with Siddharth Zarabi.
Mr. Kant, how has the railways done in the period that we have been discussing?
We had bid out railway trains. Unfortunately, we did not get a very good response, and the railway is looking at restructuring it. Railway is looking at also putting out a number of railway stations out into the privatization model. They are also looking at a number of hail rails. They are looking at railway stadiums. They are looking at railway colonies. I am quite confident that the target for this year through station trains, good sheds, hill rail, etc., will be adequately met during this year. And there will be big ticket assets with maximum contribution to the target.
Mr. Kant, how would you respond to those who would say that the steps that you have outlined, for example, for the railways, railway stations, railway lines, are willy-nilly privatization by proxy?
None of this. So that is very important to understand that we've had airports for a very long time in India. The Delhi airport, the Mumbai airport, the Hyderabad airport, the Bangalore airport. How were they created? We have created some world-class airports in this country. And you've seen traffic grow in this country because of these airports. You've seen a large number of roads being put out through the TOT model or through the PPP model. If even after 2 decades, a very senior correspondent like you is asking me questions like this, it's a very sad commentary that, if you want productivity in this country to grow, if you want efficiency to happen, if you want government to play the role of a facilitator and a catalyst, if you want, all this will happen only if we are able to bring in private sector and private investment. Government must understand that it should be a facilitator, a catalyst, and a private sector should drive businesses and drive growth of the country and should drive infrastructure creation. If we want to create shoddy investments, if we want to do shoddy infrastructure, if we want to do really infrastructure which will not be there for the next 3-4 decades, then we should ask government to do all this. I think we should break away from this mentality and ensure that the country grows rapidly. The country is able to create world-class infrastructure. The country is able to match up with the best infrastructure in the world. We have reached a stage of our growth in this country where we should not compromise with the quality of infrastructure and its operational efficiency. And that is why the asset monetization.
India's second largest IT behemoth, Infosys, missed street estimates this quarter. While revenues rose on deal wins, profit took a beating. But the company posted its highest annual growth in a decade. While Infosys added 85,000 freshers in the financial year, attrition rose sharply to 27.7%. The company aims to add 50,000 freshers in FY23. Deal momentum too was robust in Q4. The company has set a strong revenue growth guidance for FY23 at 13 to 15% for the year and an operating margin guidance of 21 to 23%.
Our large deal wins were at 9.5 billion for the full year and 2.3 billion for the quarter. In Q4, our revenue growth was 20.6% year on year and 1.2% quarter on quarter in constant currency terms. We recruited 85,000 college graduates in this financial year. We added 22,000 employees in the fourth quarter. We have an extremely strong recruitment program. This is really a reflection of our enhanced recruitment capabilities, solid brand, and deep penetration into various talent markets. This increases our comfort to support our clients in their digital transformation programs as we look ahead. Our sustained momentum in FY22, large deal wins, robust deal pipeline, and client confidence in our capabilities give us comfort to provide a guidance of 13 to 15% for growth in financial year 23 in constant currency terms.
Markets ended the truncated trading week on a somber note, sliding for a third consecutive day, selling pressure mounting with both domestic and US inflation surging. Sensex was down 237 points, shutting at 58,338. Nifty snapping its 2-week gaining streak to end below 17,500. Broader markets underperformed, snapping their 5-week gaining streak. All sectors declined this week except for Nifty Energy. Nifty IT declined 3% to post the worst week in over 2 months. Nifty Bank, Metal, Infrastructure all incurred losses. HDFC Twins continued to be on a downward spiral, pulling the indices lower. Maruti Suzuki, Dr. Reddy's Labs, Tata Motors among some of the top laggards in trade today. It's been a stellar quarter for Antares Wealth. The company has seen a 3-fold jump in its profit at 35 crores in the quarter ended March. We had a word with the company top honcho, Antares himself. Listen in.
Our plan is that we want to grow somewhere around 25% year on year in terms of our revenues and profitability. Okay, and how that is possible to do, which we find is not at all difficult. It could be only greater. It's a conservative estimate we give because the portfolio which we have, that grows by 10-12% year on year, as I told you, and so balance 12 to 15%. We are also concentrating on expanding number of relationship managers. If you see last year, we increased our relationship managers from 233 to 271 in 1 year. So we are adding 30, 40, 50 RMs year after year. So when new relationship managers come, obviously they get new business. The second, the existing relationship managers have 2 growth areas. One, from the existing clients, they can increase their share of wallet, as they say. As we find that as the clients grow with us, we keep on getting more and more funds from them. Nobody wants to give the entire portfolio necessarily to one wealth manager. So even we start, let's say, with 20-30% of a portfolio of a client. Gradually over years, we have seen because they are happy with us, it becomes from 30 to 50, and maybe at some point of time, the entire portfolio comes to us. Okay. The second way is the existing clients also keep on getting more clients by direct contact or through references. The one big advantage is, when we have such large number of clients, we get more than 7,000 families today, okay? And even each family gives us one reference in a year. We get 7,000 new references, and taking 15-20% conversion also, it helps us to bring in another 1,000-1,500 clients.
Let's take a very quick break here on the show. We'll be back with Ask Udayan this Wednesday. Do stay tuned.
Alisher Usmanov is one of the wealthiest men in the world, but sanctions by the West have left this Russian financially handicapped. His bank account is frozen, the visa restricted, and he can no longer use his dream yacht that goes by the name Dilbar after his mother. He's just one of the many powerful, wealthy men around Putin. And Putin's powerful men have been under the scanner for long now. Biden has also set up a task force to seize their assets.
Today I'm announcing that we're adding dozens of names to the list, including one of Russia's wealthiest billionaires, and I'm banning travel to America by more than 50 Russian oligarchs, their families, and their close associates.
And to add to it, a new elite group has also come under the scanner, the Silovaks. The oligarchs are super wealthy of the Russian regime. After the collapse of the Soviet Union, state assets were disbursed to businessmen and private bidders by wrongful means of corruption. The oligarchs have a deal with Putin. They can earn as much wealth as they want, given they stay out of politics. So they don't have much influence on Putin. On the other hand, a military elite group called Silovaks have a heavy influence on politics. Silovaks come from Siloviki, men of force and oligarchs. They used to carry military positions in the military and security services before the collapse of the USSR. When the USSR disintegrated, they lost all their power. But Putin helped them restore their position. Putin is said to have accumulated wealth for them. They also control important companies through not just money, but also important positions in the management. Take, for instance, Alexei Miller. However, despite...
Hello and welcome to Business Today. You're with us on Ask Udayan, the show where we answer all your questions on stocks. I'm Abha Bakaya. With me, our very own global business editor, Udayan Mukherjee. Well, with the markets responding to a whole host of triggers from the Russia-Ukraine crisis, Fed's taper view, now earnings, how smartly can you adopt a balanced portfolio approach and earn decent returns? Let's take some of those questions. If you've sent them in, it will be on this number on your screen, and we will take a few every week on TV and online. We start off with our first viewer this week from Akshay in Bengaluru. He holds Bajaj Fin. Let's listen in.
To keep in the core portfolio for next 8 to 10 years, which is a better growth stock, Bajaj Finance or SBI Card?
Well, you don't have a bad problem. Both are good stocks, and I think it's a difficult choice. But SBI Cards is a good one because I'm not saying Bajaj Finance is worse than SBI Cards, but SBI Cards is a good one because it's a unique kind of play. You don't have too many peers. Because as you would know, that SBI Cards is not just an SBI play, but it can issue cards on behalf of any other bank. And it has a 20% share of the credit card market in India. It is very strong on co-branded credit cards as well, and that space is growing. So I think we've gone through a phase of weakness in credit card subscriptions, and that phase is slowly coming to an end as the market opens up post-COVID, and you will see growth coming back. So SBI Cards should not have a problem growing at 30% over the next couple of years. The problem and the reason probably why the stock has corrected from 1150 to 850 is that there's a bit of a hangover with this RBI discussion paper. RBI is considering whether it should be capping MDR rates, merchant discounting rates, And that is very fundamental to SBI Card's profitability going forward, whether the rates will be capped or they are free to charge what they are charging now. When that cloud is lifted, I suspect you will find that SBI Cards will start performing as a stock again, which it has not over the previous 6 months. But having said all this, and SBI Cards is a good company, I would imagine that Bajaj Finance, without the hangover of the issue which I spoke about, and having a far more diversified portfolio, and given the kind of forays and progress that they're making on their digital platform, I think Bajaj Finance over the longer term might be an even more impressive and better growth play than SBI Cards. But if you are happy to own both, I think it may be just as well to keep both of these in a long-term portfolio. Not a recommendation to own any of them, but an assessment of the relative strengths of both these companies, as you asked.
Sumant Kumar also has a query. He's from Hyderabad and he holds Hatsun Agro.
Hi Udayan, this is Sumant Kumar from Hyderabad. I'm holding Hatsun Agro 100 quantity at 1100 price. So I'm planning to add another 100 quantity when stock dip to 1000 levels. So I have a long-term perspective on this stock. I can hold this stock for next 5 years. So could you please share your advice and view on the stocks? And fundamentally, I have seen this stock like P by E is trading at 60, but coming to in an organized market, so only competitor with Amul is only giving tough competition to the Hatsun. The rest of the players will be very low competitor for Hatsun. It has a good brands like Arun Ice Cream and Ibako and Arogya and Hatsun. So it has a good diversified business with the food processing. And could you please suggest for your view and long-term perspective how stock will perform?
Well, you know quite a bit about Hatsun Agro, obviously, and you know that the stock has corrected quite a bit from 1500 to 1100,000 levels where you are accumulating that name. The only problem was that I've always found it quite expensive because it's a high growth company and it's fairly solid. It trades at 70-75 P multiple, even higher than the 60 P that you spoke about. So for 2023, it's got a good, very, very strong dominant presence in South India particularly. And you're right that there are only two dominant brands in the dairy business in India, Amul and Hatsun. There are others like Prabhat, etc. But I don't think they're as dominant as Amul and Hatsun. The problem with Hatsun is that over the last couple of quarters, the milk procurement prices have gone up quite significantly. And this, as you can imagine, is hurting their margins in all their products, whether it's ice creams or curd or any of the processed milk products that they make. So we'll see whether milk procurement prices cool down or this is just a temporary blip. And once that cloud is gone, we may see Hatsun performing again in the medium term. But it's a strong company with very strong growth dynamics, and it makes sense what you're doing, accumulating using the 25-30% correction that the stock has seen of late.
All right, so then we have time for one more. Rohini has written in. She's from Mysore and has a query on Motherson Sumi. Let's listen in.
Good evening. I have 100 shares of Motherson Sumi. What should I do with it?
Well, as you know, Motherson Sumi is a very dominant player in the wiring harness market in the auto component space. It's a global player, very large, but the stock has been doing quite poorly of late. In fact, if I'm not mistaken, it's down some 40%, 45% from its high of 270. I think it's just following earnings, because if you saw the previous quarter earnings of Motherson Sumi, I think their EBITDA fell about 40%. The company is beset with a lot of problems at this point. One, the chip shortage, semiconductor chip shortage is hurting all auto companies, including them, quite badly, and that's a problem area. The other is that a lot of raw material commodity prices like copper have gone up, and these are materials used by Motherson Sumi, and therefore margins have come under intense pressure as well. And these two headwinds have really eroded their operating profit performance quite significantly. But fundamentally, it's a good company. Eventually, there will be a pullback in the global auto sector. So I don't think you should despair. But I would say that in the near term, the next 1 or 2 quarters, the chances of Motherson Sumi doing very well are not very high, because these problems will linger for some time. unless you're a longer term investor and you're betting on a global cyclical turnaround in autos, in which case Motherson Sumi will do well once again, I think in the near term you'll probably struggle to have great returns from that company.
And Lalit Kumar Jain of Imphal has a query on HDFC Life, and it's interesting to have all these queries come in from across the country today.
Namaste Udayan ji. A big follower of you for last 20 years. Sir, I have 3,000 shares of HDFC Life Insurance which I like to hold for next 8-10 years. Will I get multifold return in this company? If not, then suggest something else.
Well, I can't think of a better insurance stock, frankly. I mean, because you've probably bought the best insurance stock in the market. The three which you could look at in insurance, if that's what interests you as a sector, frankly, are HDFC Life, ICICI Lombard, and SBI Life. I mean, these three, in my eyes, are really the best insurance companies. But HDFC Life is probably the best of the lot because it's a very, very competent management. And they are slowly but surely increasing their market share every year. Their range of products is superior. Their margin profile is better than most other life insurance companies. The only problem is post-COVID, insurance as a sector has not performed well at all. In the last couple of years, in fact, HDFC Life, coming from the pedigree that it does, has actually underperformed the market quite significantly. But since you said 8 to 10 years, I think insurance is a good space. HDFC Life is one of the better companies in that space. This is not a recommendation since you own the stock already, but I don't think you should be disheartened by the recent underperformance in that company, because I think in the longer term, given the promise of the space, you'll probably make good returns over that period.
So this is really wonderful, isn't it, Udayan? For the kind of queries we've got today shows you the depth of the investor market here in India, the kind of queries we're getting across the board, and all kinds of stocks and long-term investors. So it really shows how the market has changed so much and evolved, and the kind of new investors that are now getting in.
You're right, Abha, and but it's always delightful. I'm delighted to have a caller from the northeast part of the country, because it's all that we hear all the time from people in Mumbai and Gujarat and Rajasthan and Delhi, but Imphal and far-flung places in the country. I mean, that it's far more exciting to speak to people from there. Yeah.
And someone who's also been tracking you for 20 years. So great to get that query. Thanks so much for joining us on Ask Udayan. Udayan, thanks so much for your time. We'll see you again next week and take a few more of those queries. Do keep them coming. The number is on your screen.